Hey everyone, Lance Morgan here, and today we are going to talk about how to avoid stock market losses and still get over 20% returns. And I know that sounds way too good to be true, but I'm going to show you exactly how to do it. Now, by the time you're watching this video, it may be a few days from now, but today is March 9th. 2020, and maybe you even watch this in a year from now, but everything I'm going to talk about today is still going to be very applicable to you and your situation and how you can avoid stock market losses and how you can use this strategy to actually pay for college and get all of your money back. So let's go ahead and dive into it. Now, like I said, I actually took this screen here, this was off Yahoo Finance, and I used my projector and put it up on the whiteboard here to try to get it as accurate as possible. So this is what the stock market was doing on March 9th of 2020. And of course, if you're watching this in the future, you know that, or you probably will know that right now we are dealing with this whole coronavirus thing. Now, I'm not going to get into any of the details of the actual coronavirus or the politics behind it, if there is any, or whatever your belief is on that is irrelevant. The fact of the matter is that none of us knew that this was going to happen. All the economists in the world couldn't have seen this coming. It was a virus, okay? So what better example to use when we talk about stock market losses? Now, as you can see, the stock market has plummeted because of this coronavirus. But that's not what's important. What's important is what is going to happen in the future. In the upcoming days, weeks, months, or even years, what's going to be the effects of this downturn in the economy that we're seeing? Is this going to be just a blip in the radar? Is this going to be just a crazy crash that we're going to recover from quickly and it's all going to blow over? Or are we going to see the ripple effects of the airlines that are, not flying, the events? I mean, March Madness was shut down. The NBA playoffs were shut down. Like, events left and right are being closed. We just got word that our schools are now being canceled. We're not going to have school for the next little while. So there's all these ripple effects. I've had clients tell me that their income is getting cut in half because of this. There are lots of effects that could happen that could cause this to continue to go down. So that's the big question mark. Do we know? What is your financial advisor telling you? Is your financial advisor telling you to hang in there, stay the course, and ride it all the way down to the bottom? Or is it possible that it's going to go right back up and you don't want to get out? Because if you get out now, then you might miss this, the recovery, right? So if you get out now, you're going to be selling low. You're supposed to sell high, buy low. So we don't want to get out now and risk having the market return and come back up. But what if this is like 2000 to 2002 when we had, a terrorist attack, or when we had the housing crisis of the recession in 2007 and 8? What if this is just the beginning? What if this is going to continue to go down? And what if you wished you would have gotten out right now? This is probably some of the questions that everyone is asking themselves right now. And so that is why today I really want to take advantage of this opportunity to talk about the impact of losses and how to avoid losses altogether, how to avoid stock market crashes like this, but yet still get those good double-digit gains, because obviously you could take your money and shove it under a mattress and avoid stock market losses. But how can we still get double-digit returns and also avoid these kind of gains? So let's go ahead and dive into it. The first thing that I want to talk about is the recovery time. One of the most important things about a stock market loss like this is the recovery time, the amount of time it takes to get all of your money back. So ask yourself this: could you, or do you have enough money right now in your retirement accounts to retire? Like, could you retire today? Now, most of you, even if you're in your 50s or 60s, you're probably thinking, no, I don't have enough time, money right now to retire. I was hoping for another 10 to 15 years of really good gains to get me where I needed to be to retire. So could you retire right now with how much you have in your retirement accounts? Now, the reason why I ask you that is because if you look at these numbers, if we go back 20 years ago, this is the last 20 years, going back to 2000, all right, when we had 9/11, we had the dot-com crash in here, and the stock market, the S&P 500, went down 46%. Now that means that if you had $1, it would have turned into 60 cents. Or if you had $100,000, it would have turned into $60,000. Okay? Then, of course, we had these great recovery years, right? We had a 26% return. We had an 8%, a 3%, a 13%. We had all these great returns that kind of dug us out of this hole and got us back to our dollar. But it took about 8 years to get that dollar back. And then, of course, we know that in 2007 and 8, the market started to crash again. In fact, it started in 2007, and from top to bottom, it was like a 56% drop to where you ended up with 61 cents again. You know, you're back down below your dollar. And then, of course, we have all these recovery years of 23% returns, 12% returns, and 13% returns to finally, almost get that dollar back. So the question is, once again, could you retire today? Looking at these numbers, that is 13 years to get back to where you started. So if you had $100,000 before this coronavirus, market crash, what if it takes you another 13 years to get that $100,000 back? Something to think about. It's happened before. Could it happen again? Now we can look at this chart and see that since 2012, we've had an awesome return in 2013. 2014 was awesome, 2017 was awesome, and 2019 knocked it out of the park. So we're up ahead, we've doubled our dollar. Our dollar has turned into $2 over 20 years, right? But now what's going to happen in 2020 with this whole coronavirus, or 2020 and maybe even into 2021? These are all the unknowns that we just don't know, okay? So, are you more worried about rate of return or avoiding losses? Now, a lot of you have probably heard this question before. Would you rather have $1 million today or a penny that doubles every day for 31 days? We use this as an example to teach kids about compound interest and how compound interest works. And if you look at pictures like this, which maybe you saw something like this at one point in time in your life, but of course we know this is an extremely unrealistic example of compound interest and how this penny could double for 31 days and turn into $10 million. So the first time you ever heard about compound interest, you probably had something like this in your mind, right? This idea of how money works by just compounding and turning into this like hockey stick looking graph here, where the money just keeps going straight up. Well, is that reality? Well, I couldn't recreate the penny that doubles every day for 31 days in my software program, but I took $1 and I doubled that dollar every day for 20 years. Or not every day, I'm sorry, every year. So I took $1 and doubled it every year for 20 years, and that would be $1 million. And that seems to be what we all want when it comes to investing. We want this get rich quick idea, or we want this stock tip that we could buy this stock for $1 and in 20 years it turns into $1 million, right? Well, that is what would have to happen. We would have to have 100% return every single year for 20 years for that dollar to turn into $1 million. Now we know that's not realistic, but what I really want to point out is this. If halfway through you lost 5%, just a 5% loss, that's it, okay? Your money would be half as much in 20 years. So now we know this isn't realistic, but I'm using this as an example to illustrate the impact of losses, okay, and what that can do to your money. So how long does it really take to double your money? Since we know your money can't double every year for 20 years in a row, well, like I just showed you a minute ago, if we look at the last 20 years, that's how long it has taken to double your money. If you had $1, in the stock, in the S&P 500, we're looking at the S&P 500, and this is not counting taxes or fees, okay? So if you had $1 in the S&P in 2000, by 2019, it would finally have doubled. Now, if you have ever seen this book by Tony Robbins is not an expert on money, but he was actually quite frustrated about money and used his connections to go out and interview 50 of the wealthiest people that he knows about money. And we're talking about people who counsel governments on how to invest their money, people who manage the endowment funds at some of the largest universities in the country. I mean, we're talking about, Warren Buffett's in here, all of the greats, okay? All of the people, some of which you've never even maybe heard of, but people who are considered to be some of the smartest people in the country or in the world when it comes to money. And he talks about these myths about money. And myth number one is invest with us, we'll beat the market. From 1984 to 1998, a full 15 years, and that was when the market was going straight up, okay? Only 8 out of 200 fund managers beat the Vanguard 500 index account. So everything that I just showed you back here is what may even be considered a best case scenario. Maybe you're trying to time the market. Maybe you're getting in and out. Maybe you're trying to figure out when the best time is to get in and when the best time is to get out. So maybe you didn't even get these kind of returns. This is if you stuck with it the whole time. Okay, now I also want to talk about what we call average return versus actual return. So for example, let's take a look at $100,000 and look at what happens when that $100,000 drops down 50%. So kind of like what we're seeing right now, not quite maybe 50%, but we're seeing this $100,000 that what if it just got cut in half? Like we saw in 2000 to 2002, we saw in 2007 and 8. What happens if our $100,000 just immediately gets cut in half, but then immediately bounces back? So what happens when we get these, massive drops, but then we get these massive gains, okay? So down 50, up 50. Well, that's an average return of 0. Check with your math teacher and you'll know that down 50, up 50 is an average return of 0. However, the actual return on the money is negative 25%, which can be very misleading when we're looking at investments. When we look at investments to invest in and we learn about average returns, are we really understanding the difference between average return and actual return? The best question to ask is, if I'm going to invest my money in this account, and if I had invested my money in this account 10 years ago, what would this be worth today? What's my actual return, right? Not the average return. Let's take a look at this. All right, down 50, up 100. That is an average return of 25%. Now that sounds amazing, a 25% average return. This sounds, impossible, but it sounds good. Sign me up, right? Well, if it's down 50, up 100, your average return is 25, but your actual return is 0. I had a friend once that said, hey, you got to check out this awesome hedge fund. This awesome hedge fund returned 100% last year. And I said, wow, that's interesting. So I started looking into it, started reading the prospectus, and in 1 month alone, they had lost 50% just in 1 month. So yeah, they averaged 100% return, but what was the actual return? Big difference between average return and actual return. Because if you lose half of your money, like if you've got money in a 401k right now, or in any money, any of your money, okay? It doesn't have to be in a 401k. It could be in a brokerage account. It could be anywhere. If you lose half of it, okay, whatever returns that you get, whatever gains you get are going to be on half as much money. Something very important to think about. Okay, so how about this one? Down 10, up 10, down 10, up 10, down 10, up 10. Once again, average return of 0, okay? Average return of 0, but we're down almost 5% on our money because of these losses. Okay, so you've probably gotten the point now. What is the solution, you might be asking yourself? So the solution is that rate of return is maybe not quite as important as not losing. So let's talk about that. Let's go back to our last 20 years. And what would happen if we never lost any money? Okay, so in 2000 to 2002, we got zeros. In 2008, we got a 0. In 11, we got a 0. All right. All of these years we got zeros instead of losing money. And now the trade-off is what if we only got a 7% return on the upside? Okay, so we can never get those double-digit returns that we all want. What if we could only get a 7% return? Well, even with that cap at a 7% return, it would actually be about the same and even a little bit better than if we would have ridden that roller coaster ride. All right, and this is over the last 20 years. Okay, so you may be asking yourself, well, this all sounds great, but how do we do it? Well, the way that we do it, or the easiest way that we do it, is to use cash value in what we call an indexed universal life insurance policy. All right, now, I showed you the example before of not losing. Well, the benefit of an indexed life insurance policy is that it's guaranteed to never lose. Backed by a $127 billion insurance company, or whoever it is, whatever the insurance company is that you use, all right, it's backed by this big insurance company that guarantees you that you're never going to lose any money. And instead of a 7% cap, the current cap, now once again, this is as of March 9th of 2020, one of the companies that we work with has a current cap on the S&P of 11.75. Now, there's also other options that don't even have a cap. I'm going to show you in a minute some of our clients that have earned over 20% returns. So there isn't even a cap on some of the strategies. Now, but even with an 11.75% cap, check this out. Compared to the S&P over that same 20-year window, right, you would have $3.45 instead of $2.20. Or add as many zeros to the end of those numbers as you want. It's all the same. The point is that you would have tripled your money in that time frame instead of just doubling your money in that time frame. But more importantly, like I said, what's going to happen next? Okay, what's going to happen in 2020? Is 2020 going to take away the gains over here on the left? All right, well, over here on the right with the life insurance, it's guaranteed to never lose. So whatever money you've accumulated, you're never going to go backwards. So, based on market losses, okay? So that $3.45 or the $345,000 could never go backwards. All right, that's extremely important. Now, if you've never heard about this before, like I said a minute ago, in Tony Robbins' book, when he went around interviewing all these really wealthy and smart people when it comes to money, in chapter 5, he talks about the secrets of the ultra wealthy that you can use too. And he talks about this type of life insurance, and he specifically talks about the tax advantages as well about this life insurance. But he says in here, I was introduced to this tool by two of the wealthiest individuals I know. But you don't need, you don't have to be the ultra wealthy to take advantage. Many high income earners, such as doctors, lawyers, and small business owners, will find tremendous value in the pages ahead. But those with as little as a few thousand to invest will learn how to create a version of the structure that will provide all the same benefits. Okay, so let's show you some actual case studies. These are actual clients of ours. Here's the first one. Once again, started in some pretty bad timing in 2007. This was April 28th of 2007 that this client started. And as we know, as we can see here with this red graph, okay, the stock market crashed, all right, in 2007 and 8. But the life insurance in the green here was guaranteed to never lose. So the client got 2 zeros in a row. All right, so let's say that it's today, right, March 9th, and let's say that you started one of these policies today. All right, there's two things that could happen. Number one, the market could continue to go down, and you would get zeros just like this client did. All right, so that's one option. The second option is that the market could turn around and go back up. And then, of course, you could also make money on the upside like this client did in 2010 when the market bounced back and he got an 18.8% return. All right, so once again, still can get double-digit returns in these policies, but guaranteed to never lose. This client, in a pretty crappy time frame here, starting off on the wrong foot with 2 zeros, still was able to average a 6.8% return. This client also got a 0 in 2016, but has averaged 8.34%. Also, take a note of the green line versus the red line to see how this life insurance compares to the S&P 500. All right, here's another one. 2 out of the 5 years, they've gotten 0. But check that out, a 20% return. Have you ever heard of a 20% return in a life insurance product that is guaranteed to never lose? Well, it can definitely happen. And as you can see here, it's been staying right on track with the S&P 500 without the losses. Okay? Here's another one. 50% of the time they've earned zeros because of the time frame here. So 2016 and 19 got zeros, but was still able to once again get over a 20% return in there, averaging 7% without any risk of the stock market. All right. Now, here's another one, 10.25%. Look at the green and the red lines there. All right. Here's another one, 9.29%. Okay. Doing better than the S&P. Here's another one, 10.28%, doing better than the S&P. Okay. Here's one that's my favorite because it really tells the best story. If you can see the red line represents the stock market when it crashes, but the life insurance is guaranteed to never lose. All right. But you can also see that when the S&P jumps back up, you may not get the same kind of rebound in the life insurance. Right? But you're not going to lose, which ends up being still an 8.4% return for this client. All right, now let's take a look at another client that we had that started on the 2nd of January in 2018. That's when the client started, and this is going back and looking at what the S&P 500 was doing back on January 2nd of 2018. Well, since that's when the client started, it looks at when the policy renews to credit the account. So on January 2nd of 2019, it was down. As you can see, it went from here to here. All right, so it was down. Well, it just so happens that this client who started on January 2nd of 2018 was able to avoid those losses because it's guaranteed to never lose. But because of the way the insurance company was managing this money, they actually got a 0.29% return. So it made a little bit of money there, but definitely avoided the losses. Now, this is actually a completely different client who started on January 2nd of 2019. Now, if you remember, back in December of 2018 and into January of 2019, we were still in this, big crash that we had. It was like the biggest drop in December that we'd ever had. And here we have, you can see on this chart here, that this particular client started on the way up, right? The market was starting to come back from that December crash, but it was still down. So 1 year later, on January 2nd of 2020, the market was up. And the way these life insurance products work is that you are going to get that credit, right? So you don't have to worry about what happens in between. It looks at what happens when you started, and it looks at what happens a year later. And then it credits your account. This client earned a 21.25% return, okay, in a life insurance product. Now, it didn't do as well as the S&P 500 because the S&P 500 jumped back up, right? But it still got 21.25% and was able to avoid all of the losses. Now, at this point, you might be saying, well, this is great, but it sounds way too good to be true. So let me break it down and show you exactly how they do it. On the left here is actually a general portfolio of one of these insurance companies. And as you can see, most of it is in bonds. There's some stocks, a little bit of mortgages and real estate and stuff, but most of it is bonds. This is what we call the general portfolio of the insurance company. Now, this is where the money is actually invested. This is how they can guarantee you that you're not going to lose any money because it's a very conservative portfolio. In fact, if you break it down, even those bonds, just breaking down those bonds, we've got most of the money in those Class 1 and Class 2 bonds, making this a very, very safe place to put your money. Well, this particular portfolio averages about 5% over time. Now, that doesn't exactly explain how you get these 20% returns, does it? But this is how the majority of the money is invested. It's invested into this safe, conservative bond portfolio. Then what they do is if you were to, just as an example, if you took $1,000, all right, to save as a premium into this life insurance product, they would take $950 and put it into that general portfolio. That general portfolio, remember, is earning a little over 5%, so that's going to get you back your $1,000. All right? Or if you had $1 million in one of these plans, right, you would get your $1 million back as well. So you're guaranteed to never go backwards based on any stock market losses or anything like that, because The only thing that they are risking is that $50, which is basically your interest. In other words, they're investing the interest and they're putting it into the options market. Okay? So by law, they're being safe with your money. They're protecting your money. All right? They're not being risky or careless with your money. They're protecting your principal, but they are putting the interest into some advanced kind of investment strategies that can earn significant returns. And some of these insurance companies are the biggest options traders in the world, and some of these insurance companies outsource this to an investment banking firm like a Goldman Sachs or a JP Morgan or somebody. But whatever the case may be, they're getting great returns on that $50, but they could also lose it. Okay? So if they lose that $50, that's okay. The only thing they ever risked was your interest, and that's how they can protect that $1,000, and that's how they can guarantee you that you're never going to lose. Now at this point, you might be saying, okay, well, what about the high fees? You've maybe heard about life insurance before. Maybe somebody's even shown you a whole life policy or something in the past, which, by the way, this is not whole life. This is not return of premium. This is not a variable universal life where the money is in the stock market. This is what we call an indexed universal life policy. And I'm going to show you how the fees work, okay? There's a right way and a wrong way to set up life insurance for maximum cash accumulation. Now, if you're trying to buy life insurance for estate planning, or you're trying to buy life insurance to protect your family, to replace your income, well, then you can buy some term insurance to replace your income and to protect your family, right? This is about maximizing the cash value, which we can use while we're alive. Cash value is like cash in the bank, okay? It's just with an insurance company instead of a bank, okay? So we want to maximize the cash value. So let me show you how to do this while minimizing the fees. So here's the scenario, okay? We're going to have the same client, the same insurance company, the same product, the same rate of return, the same amount invested, but a different insurance amount. All right, that's the key. I'm going to also show you maximum cash value versus maximum life insurance, high fees versus low fees, and high commissions versus low commissions. All right, you may be wondering why your advisor has never shown you this, why your financial advisor has never shown you this, or maybe why your insurance agent has never shown you this. And I'm going to explain why that could be. All right, now, all right, here's the scenario. On the left, we have maximum cash value. Remember, this is the same client, the same amount invested. Everything is the same except for the amount of insurance that you're buying. Okay, on the right, we have maximum life insurance. Now, that might be why you've never heard about this before. Insurance agents get paid commissions on the amount of life insurance that you purchase, not the amount of cash value that you have in your account. Okay, so on the left, you're buying half as much insurance, which means half as much commissions. One of the reasons why insurance agents don't like to sell you a scenario like this over here on the left. It doesn't maximize their commissions. Could be one of the reasons why you've never heard about this before. All right, now look at the account value. On the left, when we minimize the insurance and we maximize the cash value, look at how it grows to over $3 million by age 95 for this particular client. And look at how it compares to some of the other investments like your taxable brokerage account, or a tax-deferred account, which would be your 401ks, your 403bs, your 457s, your IRAs, or even the purple, all right? The purple is your Roth IRAs and your 529 accounts. In fact, that blue one, the tax-deferred account, most of that, or not most, but some of that money belongs to the IRS. So that's not even all yours. In the life insurance, it's all yours. It's after taxes. It's like a Roth, they call it the rich person's Roth IRA. So all that money is yours. So even though it looks like you've got just as much in the blue line there, a lot of that blue line belongs to the IRS. And how much, you don't even know, because you don't know how much taxes are going to be in the future. All right? So you don't know how much of that is going to be yours. Now over here on the right, where we had that maximum amount of life insurance, you can see what happens to the green line. It's like it needs Viagra or something, okay? And these latter years, the growth of it really starts to suffer because you're still paying for all this insurance and the fees have gone through the roof, and I'll show you that next. But there's a huge difference. I mean, we're talking a little over $1 million by age 95 versus over $3 million. Huge difference because of how this is set up. It's not the product, it's not the company, it's how it's set up. Okay? So if you like to look at the numbers themselves, we're talking 3.2 million by age 95, 1 million by age 95 over here on the right. Okay, big difference. All right, now, the reason is because of the fees. If you look over here on the left, the total charges, all right, are very low compared to other investments. Once again, another reason why you've maybe not heard about this before. When I got into the financial industry, the first thing I was told was go get all these licenses so that I could set up 401ks and IRAs and all this money in the market and be a fiduciary so that I could earn what we call assets under management, right? I could earn a percentage of the money under management. Now, if you have a financial advisor or a fiduciary or somebody that's really good at managing your money, then great, okay? So if they can help you to avoid losses, if they can help you to outperform the S&P, then great, okay? If you're happy with where you're at, then more power to you, all right? But this is a really easy way that everyone can do it and keep your fees low. Because think about it. If you're paying 1% in fee, which by the way, I think this is 1 or 1.5% in fees that I'm showing here. All right. If you're paying a 1 or 1.5% in fee, then as your money grows, your fees are growing. Because if you have $1 million, you're going to be paying $10,000 to $15,000 a year in fees. Okay. Now over here, it's different. It's not a percentage. On the right, we have this maximum life insurance. We're paying for this $600,000 of insurance. And when we're 90 years old, we're still paying for $600,000 of insurance. Now, I didn't really explain this, but over here on the left, we started with $300,000 of insurance, but there's this little known secret that the IRS came out with that allows us to reduce the amount of insurance, which actually reduces our fees over time. But over here on the right, we actually kept all of the insurance the entire time, and that's what most people do. And so most people end up paying these ridiculous amounts of fees in the end, which causes your account value to go like this because you're paying so much in fees compared to the growth on the money. This is why most people don't think that life insurance is a good idea, because they've probably experienced or seen illustrations like this instead of like this. Okay, so believe it or not, if done correctly, life insurance can be significantly cheaper than your most common investments like brokerage accounts, all right, IRAs, 401ks, even your Roth IRAs and your 529 accounts. The life insurance could still be cheaper. All right, now here's a summary. On the left, we have our fees, okay, of $177,000 in fees compared to $967,000 in fees. Huge difference between those two, which is why we have $3 million of cash value versus $1 million in cash value. Now keep in mind, all of this money can be used income tax free during retirement or to pay for college or any other expense for that matter. Okay, so now at this point you might be wondering, why isn't everyone doing this? And why hasn't my financial advisor shown me this? Well, high fees equal high commissions. Low fees equal low commissions. Okay, so how does a low-cost life insurance compare to other investments? Well, let's take a look at a 1% fee on all these other options compared to the life insurance. And as you can see, by age 85, we're talking about $88,000 in cumulative fees compared to $373,000 in taxes and fees, $241,000 in fees, and $173,000 in fees. So as you can see, one of the reasons why you might not hear about this is because somebody might want the commissions that comes from those higher fees. All right? So once again, insurance agents get paid based on the amount of insurance that you buy. Financial advisors, or those who are making money on what we call assets under management, they're making these high fees on this residual income that they get every single year. Okay? Now, How does this help me pay for college and get all of my money back? Well, paying for college and getting all of your money back is as simple as earning a positive spread on your money. In other words, you need to earn a greater average return on your money over time and borrow other people's money at a lower rate, even if you have a senior in high school and no money saved for college. It basically looks like this, okay? It's all about the positive spread. So you want to leverage your money instead of spending it. Okay, consider this analogy. If a bank paid 7% on savings and you could borrow the bank's money at 5%, would you use savings and cash flow to pay for college or borrow the money from the bank at 5%? Hopefully you said you would borrow the money from the bank at 5% and allow your money to keep growing at 7% in the savings account. Now we know that there are no banks currently that are offering an option like this, but we can do this through insurance companies because our money is going to be invested into this general portfolio, all right? And then we have some of the money into the options market, but take a closer look at that general portfolio. Some of that is what we call policy loans, which basically means the insurance company is giving you a loan using your money as collateral. It's almost like getting a home equity loan and using your home as collateral. You don't have to actually sell the house to get to the equity. You could get a home equity loan and allow the house to continue to compound. All right, so the insurance company, or at least this specific insurance company, will allow you to borrow money all policy years. That means next year, or that means in 5 years from now, or in 100 years from now, you could borrow money at 5% fixed. Are you worried about interest rates going up? Well, how would you like to always be able to borrow money at 5% fixed from the insurance company? Now, why would they be willing to do that? Because it's using your money as collateral to secure the loan, and it fits as a safe investment in part of their general portfolio. That's why they're willing to do it. So it would look a little something like this. The green would represent your money growing at, let's say, a 6 to 8% average return. And then when it comes to pay for college, you could borrow the insurance company's money at 5% and allow your money to continue to grow. Now, here's the part that's going to blow your mind. You're able to pay back those loans that you borrowed from the insurance company, but you don't have to. Believe it or not, you can actually borrow the money from the insurance company to pay for college or to buy a boat or to retire or whatever the case may be, and just allow it to accrue interest at 5%. And as long as your money is growing at 6 to 8%, you're creating a spread. Now, if you're not earning 6 to 8%, let's say that this coronavirus wipes out the entire, half of the population and we go into some, Armageddon scenario. Well, we don't have to borrow the money at 5% if we don't think we're going to earn 5% on our money, all right? But if historically we're able to earn 6 to 8%, then we would want to borrow the money at 5% to create that spread. All right, and if we don't think we can earn 5%, then we can just use our own money, just like you would use money out of a 529 account or a 401k or anything else. We could just use the money that's ours. All right, but if you could use the insurance company's money and allow your money to compound interest, that would be ideal. Now, these insurance loans are guaranteed. You don't even have to qualify for those loans. When's the last time you went to a bank to qualify for a car loan or a home loan? It's horrible. With these loans, you just fill out a piece of paper, send it in, a few pieces of paper, send it in, and they send you the money. There is no loan qualification, all right? There's no application process. There's no credit check. There's no structured payments. They don't even require an interest-only payment. There's no payments required. The loans get paid back upon death, or you can pay them off if you want, but if you don't, they're going to get paid back upon death. Now, why is that? Because it's an investment. If you borrow $100,000 from the insurance company, someday you're going to owe them $200,000, depending on how long it takes, before you die. At 5%, you're going to owe them $200,000. That's going to come out of your account, but your money is going to keep growing. At a 6 to 8% return, you borrow the money at 5%. That's the spread that allows you to pay for college and get all your money back. Now you might be saying, well, what if I have a high school student and I don't have any money saved for college? Maybe you even have a senior in high school or even a freshman in college, right? Or a sophomore in college, but maybe they're going on to grad school, whatever the case may be. What you can do is you can save your money where the green is, okay? That green money represents your money that you start to save. You can use the college loans to buy yourself a little bit of time, because the college loans, the PLUS loans and the Stafford loans, don't have to be paid back until 6 months after graduation. Now the Parent Plus loans, they default to asking you for a payment, but you can fill out a form and request that those payments get deferred until graduation. So now, instead of borrowing the insurance company's money to pay for college, we're actually borrowing the insurance company's money to pay back those college loans, which is why you could start this today, even if you have a senior in high school and no money saved for college. All right. Then, once again, you could pay back the insurance company if you wanted to, or don't pay them back until you die. So this works great even if you have kids already in high school. So let's review the 3 steps to pay for college and get all of your money back. Step 1, earn uninterrupted compound interest on your money. Do not spend it, okay? You want to leverage it. You don't want to lose it either. You want to avoid market losses, which is why this training today is so important to understand. You want to avoid market losses, because if you lose 50% of your money, that's the same as spending 50% of your money. You only have half left to be able to earn an interest on, okay? So you want to avoid stock market losses or losses in general, okay? Step 2, borrow other people's money at a lower rate than you can earn on your money. All right? You've probably heard it referred to as OPM. Maybe you've read a Rich Dad, Poor Dad book or something like that. Robert Kiyosaki, Tony Robbins. A lot of people talk about other people's money. Now, ideally, you want a fixed interest rate, not a variable rate. Be careful, because some insurance companies have a variable rate loan, but the one I showed you has a 5% fixed loan. So that is the ideal scenario. You want guaranteed loan approval, okay? And you want an unstructured loan payment. I mean, you could go out and get a home equity loan right now, but then you've got a payment on that home equity loan, okay? And step 3 is you want to earn a positive spread on average over time, even if you have a senior in high school and no money saved for college. Because if we believe in this concept of uninterrupted compound interest, it doesn't matter if you're 55 years old and your kid is just now going to college and you have no money saved. This will still work. And with about a 1% spread, you're going to get all your money back in about 25 years on average. With a 2% spread, you're going to get all your money back in about 18 years. And a 3% spread, you're going to get all your money back in about 14 years. Now, this is just an average. Obviously, there's other scenarios. We can run specific numbers for you to show you your exact numbers. But this is, an example of how important that spread is. And so if you're 50 years old, right, and you got a 2% spread on average, you could have the entire cost of college back, okay, by the time you're 68 years old. Still plenty of time to use all that for retirement. Now, this is not just for college funding, okay? This could be used to increase your tax-free retirement income. This could be used for increased emergency fund. This could be used for weddings, to pay for weddings. I have 4 girls myself. I have 5 kids total. My 5th one was a boy. I have 4 girls, which means 4 weddings to pay for. Almost as expensive, well, not quite as expensive as college, but also a major expense that you could use this strategy for. Real estate investing, all right? I used to teach people how to use this to buy and flip real estate with, or to use as a down payment on investment properties. You can use this for any number of things. Business opportunities that come along, investment opportunities. Right now is a beautiful opportunity to access maybe the insurance company's money at 5%, allow your money to keep growing or at least not lose, okay? And use that money to buy low, all right? I was looking at what Tesla stock was doing today because, I've seen all these companies like Tesla and Amazon and all these companies that are more than likely going to do just fine over time, right? But maybe now is the time to buy low. But what are you going to buy low with? All your money is in your retirement account down here. But what if you had some money in an investment like life insurance that allowed you to come into the market when the market's down and benefit from the ride going up. Okay? All right, income during a job loss. I can't tell you how many times my clients have called me and said, I need to access some money temporarily to get me through this this time that I got laid off and I got to get a new job. I need a new job, or maybe, in fact, I had a client just actually talk to me the other day saying his pay is getting cut in half just because of this coronavirus and how it's affecting their business. So, this is a great source of money that you can access during some unexpected expenses or job loss. All right, paying taxes. I know my dad's a big real estate investor and he's always used his life insurance to pay his taxes every year, which is great because then if you ever receive, maybe you sell some real estate or something and you have a big lump sum, or maybe you receive an inheritance, you could take that lump sum and use it to pay off all your loans and then have access to all that money income tax free. So you can do something like that. Or any large purchase and so forth. You kind of get the idea here. Also, now for those of you who have a 401k right now, or maybe more importantly, you have an old 401k that's sitting there, or maybe some IRA money that's doing this, all right? And your financial advisor is telling you to stay the course and you're not sure whether you should stay the course or not. Well, they have very similar strategies to what I just explained with the life insurance in indexed annuities that you can actually use. You're not going to get maybe 20% returns, but you can still get, single and double digit returns in annuities and be guaranteed to never lose. And there are annuities even that have no fees. And so there's other options that are, now these aren't the old school annuities that maybe you've heard about, but these are awesome annuities that can give you a guaranteed lifetime income. Even if you run out of money, they'll continue to pay you the rest of your life. So really cool options that are out there for old IRAs or 401ks and things like that. Okay, in summary, this money is sheltered from the EFC calculations. Now, for those of you who understand what the EFC number is, I talk about that in my main training, but that is how much the government and colleges think you can afford to pay for college. But if you're saving money into a 529 accounts, that's going to hurt you when it comes time for financial aid. The life insurance is going to be exempt from that in most schools. There may be one or two out there that doesn't exempt it, but most of them will be exempt. All right. Now, 6 to 8% average return and higher. Tax-deferred growth on the money, tax-free access to the money, no stock market losses, access to the money at any age. Cash value can be used as collateral to borrow the insurance company's money at a fixed 5% depending on the insurance company. All right, unstructured loan payments, guaranteed loan approval, no applications or credit check. All right, low fees if set up correctly like I explained. All right, average positive spread of about 1 to 3%. Okay, and the death benefit as a backup college funding plan. Now, as a word of caution, not all insurance products can average 6 to 8% and higher. Not all insurance companies allow you to borrow their money at a fixed 5%. Some have variable rate loans that can go as high as 15%. Right? Insurance agents may want to sell you too much life insurance, which can result in less cash value. Remember, high fees equal high commissions, so be careful. Now, we have an education funding solution program that will walk you through everything you need to do to calculate the cost of college, minimize the cost of college, look for schools that are going to offer you the most free money, calculate how much free money you're going to get from the schools. We have a scholarship calculator as a bonus in this program. We're going to show you how to set up this life insurance. We're going to run the numbers for you. We're going to help you get it set up. We're even going to review it for you every year to make sure you're on track. I mean, we've just got a lot of services in this particular program for $197 for a limited time. And so this is a great resource if you're wanting to know how to apply all of this for you personally. We work with you one-on-one, either myself or one of my college funding specialists. We're going to work with you one-on-one. Doesn't matter where you're at in the country. We do everything online. We'll share our computer screen, work with you one-on-one, run your numbers for you, and show you exactly how to implement some of these strategies that we talked about today. If you don't need this strategy for college, but you want to use this strategy for something else, it works for that as well. Like I said, there's a lot of different ways to use this particular strategy. So click the link below to learn more and to work with us. We would love to help you out and show you how to avoid stock market losses yourself. So thanks for watching. Feel free to share this with those that you think could benefit from it. And right now, there's probably a lot of those. So go ahead and share this with others. And we're here to help, and let us know if you have any questions. If you got this in an email, you can just just hit reply on the email and ask questions if you have any questions. But once again, click the link below to work with us. We would love to help you out. So talk to you soon.